Hello everyone, welcome back to the channel. This is Dr. Ambuli, Associate Professor, SRM Institute of Science and Technology, Chennai. In today's video, we are going to discuss one of the most important tool of financial statement analysis, that is ratio analysis. Now we'll start with what do we mean the term ratio and the basic definition involved in ratio analysis. Then we'll discuss about the importance of ratio and types of ratios and advantages and disadvantages of ratio. So first we'll start with what do we term ratio analysis. So in the financial statement can be analyzed with help of various tools. One of the important tool used in the organization is ratio analysis. Is a ratio analysis a technique, or we can say as a tool which are used to evaluate the financial performance and the position of a business by establishing a mathematical relationship between two financial figures taken from the financial statement. When you take a financial statement consists of trading account, P&L account and balance sheet, or we can say income and expenditure statement and balance sheet. In this statement, we are using various financial variables. It may be expenses, or income, liabilities or assets. Among these, so any two financial variable, we are going to find out a relationship with the help of mathematical analysis, that is called as ratio analysis. By using this tool, we can able to find out the financial performance of the company, and also what is the position of the company can be analyzed with the help of ratio analysis. In a simple word, we can explain the ratio analysis means compare one figure with another figure to understand how well the company is performing. So one financial variable we are comparing with another financial variable and see how these two financial variables are related, and based on the ratio we can able to express the performance of the company in various aspects. For example, if we compare the current asset with current liability, we can able to say about what is the liquidity position of the company. So liquidity, that is liquidity, how the company can able to bear or able to face the liquidity position of the company. That is able to face the cash immediately. They can able to settle the outsiders or the internal holders within the with the help of the cash which is available in the business. That is called as liquidity position of the company. So this ratio analysis is useful to convert the raw accounting data into a meaningful information. In the financial statement, we are expressing all the expenses and incomes, liabilities and assets. Those data just what actually we are doing, we are incurring and we are doing in the organization. Those information we are recording in a book of accounts in the form of financial statement. We are following the basic accounting rules of accounting. So those data can be just we are listing out those data in a financial statement, but those data should be a meaningful by using analysis. One of the analysis nothing but the ratio analysis. Next, we'll move on to the definition of ratio analysis. So just in this video, just I have explained the ratio analysis by using a definition, accounting standards and financial expert. Another one is simple definition. As per accounting standard and financial expert, the ratio analysis is nothing but a systematic use of ratios to interpret the financial performance to interpret the financial statement so as to assess the financial performance and position of an enterprise. That is, the financial performance and position can be evaluated by the variable which is the financial variable which is available in the financial statement can be interpreted or analyzed with the help of ratio analysis. That is called as ratio analysis as per the accounting standard. In a simple definition, ratio analysis refers to ratio is an expression of an quantity relation between two related accounting figures. So that is ratio means that is finding proportion between two numerical variables which are available in your financial statement, or the numerical relationship between two related accounting or financial variable which is available in financial statement. That is called as ratio analysis. With the help of ratio analysis, we can able to interpret the result and compare with the past year of the same company, or compare with your company with a competitor company, and also you can evaluate your performance of your company can be by using the tool called as ratio analysis. The next one, we will move on to the what are the importance of ratio analysis, or we can say why the ratio analysis is important in when you are doing a financial analysis. The first important is help in financial performance evaluation. So we are running an organization, but at the end of the year we are preparing a financial statement. The financial statement expresses the profit or loss as well as the total of assets and liabilities. But by using a ratio, we can able to know what is the profitability position of the company, how much the company is efficient, and what is the liquidity position of the company, and also you can able to determine whether the company is a solvent reference to whether you can able to continue a business continuously for a longer period. All this can be analyzed with the help of ratio. The next important of using ratio analysis, useful for decision. So whenever if you have to take a decision, so in such a case we are using the ratio analysis. So when you are doing any activity, we have to plan, we have to control, and we have to take a decision. Among this, the important aspect is nothing but taking decision. Whatever plan you did, or whatever comparing your actual performance standard, but taking decision is very very important. So in an organization we can take a decision to expand or to improve, or changes or anything, taking decision with respect to reducing cost or increasing investment. In all this aspect, this ratio analysis is playing an important role. The next one, it helpful to the investor. Investor use the ratios in order to know about the earning per share, what is the profit from the investment, and also we can able to calculate the various profit ratios such as gross profit ratio, net profit ratio, what is your operating profit ratio. All this we can able to find out with help of ratio analysis. So it also helps the investor whether we can make suppose the investor already invest in the company, so whether the decision which are taken, which has chosen the to make investment in the company is right or not, or if you want to invest in this company, if you are plan to invest in this company, in this case whether we can invest or not, we can able to decide, or and also whether we can purchase some more shares in this company, or we can sell shares in this company. Like this, taking n number of decision by using the ratio analysis. The next, it is helpful for the creditor's point of view and lender point of view. So bank and financial institution before lending money, they will see the financial statement. By using the financial statement, they are not able to understand what is actual position of the organization. So in such a case, this ratio analysis is determined, um, uh, give a true and accurate figure about the organization by computing the various ratios such as liquidity ratio, and also solvency ratio. Mm. Next one, we'll move on to the next important is nothing but enables comparison. Ratio analysis help to compare between two companies, between the past data with the current data of the same company, or we can able to see whether we meet out the standard, because each and every ratio we have an ideal ratio. So whether by calculating actual ratio, you can able to compare with the ideals ratio and see whether we meet out the industry standard or not. All this you can able to can all this you can able to do by using the ratio analysis. The next important of ratio analysis nothing but identify the strength and weakness. Each and every organization, they want to know about the where they are and what actually they have to do and where they have to improve. All this we can able to find out by using the ratio. Ratio is highlight the this it provides a accurate result about the various aspect of the business. So based on that, they can able the business can able to know which where they are strong and where they have to do, where they are weak, and where and what type of corrective action in order to overcome those weaknesses. So these are the various important or need of calculating the or using the ratios in a ratio and as a ratio as a one of the analysis in using the financial statement. Then next we'll move on to the type of ratio analysis. So ratio can be classified under various aspects, that is based on the usage of financial statement and or how the business is expecting in various aspects, or the purpose of doing the business. In all these cases we are the ratio analysis are classified. So here under this I am classify the ratio analysis, that is liquidity ratio, uh, solvency ratio, uh, then profitable ratio, turnover ratio, and based on the market requirement of the ratios. So here the first one we will see about the liquidity ratio. Liquidity ratio we are calculated to measure the short-term financial position of the company. So because we have to run a business smoothly to meet our day-to-day activities. In this case, where actually we are, in order to understand the current situation, we are calculating the liquidity ratios. Under liquidity ratio, we have three type of ratio. One is current ratio, number two quick ratio, and number three cash position ratio. The next important type of ratio is nothing but profitable ratio. This profitable ratio can be analyzed to measure the earning capacity of the business. That is, in order to know about the what is the capacity of the business. Even if you are calculating financial statement, we are deriving the gross profit or net profit, but those figures will not give have accurate aspect of the business. So in order to understand by the layman, in this case, these profitable ratios will give a accurate picture about the particular business. So these are the various profit ratio we have calculated. One is gross profit, number two net profit, number three operating profit, operating ratio, expenses ratio, return on investment ratio, return on asset ratio, and return on net worth or equity ratio. Like this we are calculate different profitable ratio in order to know the better financial performance of the business. The next one is solvency ratio. So solvency ratio is helpful to measure the long term financial position of the, that is whether um, uh, we can continue for a business for a longer period. What about the stability of the business for for a longer duration? All this can be measured with the help of the solvency ratio, whether our business is solvent or not. So in order to identify this, we are calculating the various type of debt equity ratio, property ratio, fixed asset ratio, capital gearing ratio. So these are the various ratios we are calculated under the solvency ratio. The next one we can call as activity ratio or turnover ratio. This ratio is helpful to measure the efficiency of the. So active ratio is used to measure the efficiency um, of the business. That is how we are efficient in using the assets and liability with respect to the turnover of the business. In such a case, we are calculating various type of ratios. It's not number one will be inventory turnover ratio, debtor turnover ratio, creditor turnover ratio, total asset turnover ratio, capital turnover ratio, working capital turnover ratio, inventory turnover. Uh, Capital turnover ratio. Like this, we are calculating the various ratios uh, under the turnover ratio. So under turnover ratio, we are calculating the debtor velocity, creditor velocity, as well as the stock velocity. In order to these type of ratios will helpful to indicate the efficient about the how we are efficient in managing our business or not, can be able to identify with the help of activity ratio. The next one we can next important ratio under the type of ratio is market value ratio. We want to know about what is our company position in the market. So these ratios, so this ratio will be is required for all type of stakeholder, investor point of view, creditor point of view, employee point of view, or customer point of view. So they want to know about the market value of the value of the particular company. So in this case, we are calculating the earning per share ratio, price earning ratio, market value per share ratio. So all these ratios we are calculating under the market value ratio. The next we will move on to the what are the advantages of and disadvantage of ratio analysis. If you take anything in a general, we have advantage as well as disadvantage. Similarly, in the ratio analysis also we have advantage as well as disadvantage. So what are the advantage of using ratio analysis, and also what are the limitation by using the ratio analysis? So here first we'll see about the what are the advantages of using ratio analysis. The first one, it simplifies the financial statement. The first advantage, it conveys that simplifies the financial. In the financial statement, we have listed various expenses and income, assets, liabilities, and assets. That can be easily can be viewed or can be go through by the if it is a small business owner. If it's a large business organization, in this case, each and every expenses we have various lists over the period. So in this case, we know to know about the particular period, the performance about the organization. In such a case, we are using the in order to simplify the financial statement, we are using the tool called as ratio analysis. So in this case, by using a ratio analysis, we can able to know that the ratio can be expressed in percentage or times, that express a meaning about what we require from the financial statement. The next advantage is help in financial performance evaluation. So ratio helps in evaluating profitability, liquidity, solvency, and operational efficiency of the business. So this helps the management to understand about the overall performance of the company. Next, the advantage is useful in decision making. Already in the importance we have discussed about the decision. So whatever we are doing, the decision should be in a right one. So in order to take a right decision, we have to plan, control, follow the policy, and at last we have to take a decision. So decision should be apt by by seeing our ratio analysis. The next one is facial comparison. So ratio helps is helpful to inter comparison, inter-comparison, and compare with the industry standard. All this comparison is helpful for the business to sustain in the competitive market. Next one, it helpful for the investor as well as for the creditor point of view. So investor, before making investment or whatever they are invested, so in this case they can by seeing the ratios whether they can further they can invest, or they continue the investment, or they can discontinue the investment. All this can able to by go oversee about the ratio. Similarly the creditors also, so when they can before lending money or before supplying goods on credit, so by seeing the ratios they can able to study about the repayment capability of the particular organization. Based on that they can decide about the whether they can uh, lend or send goods for on credit. The next one, able to it helpful to identify the strength and weakness of the each and every company. They want to know about where they are strong and where they are weak. So by using by calculating the ratios, we can able to state which aspect we are very strong and which aspect we are weak, and how to overcome the weak, how we can maintain the strength, and all those we can able to study with help of the ratio analysis. So the important advantage of his yearly warning system. So unfavorable trend in ratios act as a yearly warning signal for the financial problems, allowing timely action. So by seeing the ratios, so anything is any ratios, it gives a negative sign in such a case, that based on the ratios the company has to take a action, immediate action, and to overcome from the particular problem. So these are the various advantages of by using the ratio analysis. So now whenever if you say advantage, similarly we have a disadvantage by using a ratio, by using ratio analysis. The following are the limitation. The first one is based on the historical data. So when calculating the ratios, so always we are calculating based on the data which is available in the financial statement. So based on, so that will not give a true or accurate about the future, because the scenario has been changing. So when you calculate the ratio of the past, based on that we identify one aspect will be weak and another aspect will be strong. On that basis we are taking some action. In the current scenario is totally changed. In such a case, whatever action we are taking will be a waste. So the next disadvantage, effect of window dressing. Window dressing, a financial statement always when you are prepared by we are not showing actual or real information. So in order to convince the investor as well as the various stakeholders, so we are just we are manipulate some information or to address. So that will not, based on that if you are calculating any ratio, that will provide not a true aspect. Then ignores qualitative factors. While calculating the ratios can be calculated only well with help of the quantitative information or a numerical information or a financial variable which are available in the financial statement. So apart from the financial information or in numerical values, we have so many activities involved without the financial or with help of qualitative factors. Those factors we are totally ignored while using the ratio analysis. Then lack of standardization. Different firm may use a different accounting policies, so this will not be helpful for comparing the accounting or industry standards. So when one of the disadvantages of ratio inflation, the value of we are valuing the money will be more compared to the what actually we have. So that aspect will provide a negative aspect in the case of company, because the value of money will be less what actually we have in the future. So that based on that, if you have that will be have a negative aspect in the real scenario. The next disadvantage will be no single ratio gives a complete picture. So when you are calculating ratios, we are calculating the financial performance of company by calculating profitable ratios, turnover ratios, solvent. So these single ratio will not have a give a true picture about the overall of the business. And also it provide a misleading without proper interpretation. When you are calculating ratio, we have to give a interpretation. So interpretation has to give as based on the present aspect. But what we are calculating based on the giving an interpretation will lead to a wrong path for future also. So these are the various limitation when you are using a ratio analysis. So in order to overcome these limitation, so we have to compare. When you are calculating ratio analysis, we have to consider qualitative factors, as well as we have to consider when you are calculating ratio based on the what actually happened in the real scenario. So so these are the various aspects we are used in ratio analysis as an introductory part. These theoretical aspect will be helpful for the this ratio analysis. Very generally we can say is very useful for the all stakeholder of the company by taking the consideration with comparing with the qualitative aspect, as well as the what is the current or real time scenario will happen in the industry. Thank you. Thank you for happy learning.